ado, let's get on to the main bit of today, which is talking about the global economy. So, economies of individual countries are linked together because changes in a single economy have ripple effects on others. So this reflects the total amount of measurable economic activity going in the world. And this all happens due to globalization. So globalization is the process of increasing the integration of economies throughout the world. So this is why changes in one economy or one country are going to link to changes in another economy. You know, for example, should there be a fall in GDP in Australia, that's going to affect our exports. Our exports will then affect all the countries who we export to. Then, you know, all of a sudden they don't have the right imports, then they can't produce what they need to produce, or their quality of life decreases, etc., etc. And you just start this big chain of events in the global economy. So, as a proper definition, globalization is the potential and actual movement among nations of labor, investment, finance, trade, technology, and transportation. So super important that you know these are like your big 6 things that you're going to talk about if you want to talk about globalization, particularly if you're talking about globalization in terms of an essay question. You could break up your response in terms of that lift. So that's labor, investment, finance, trade, technology, transport. Obviously, you don't have to talk about all 6 if you're talking about them in an essay or even in a short answer, but those are some of the topics that you could use to sort of break down that response. So that lift are the major indications of economic integration, which increase your globalization. So yeah, pretty much if you're thinking about the current economy, or the current global economy, it is very, very heavily integrated. So things or economic events in one country are really going to impact other economies, particularly your big major economies. So for example, with Australia, should there be a fall or something going wrong in the American economy, Australia would really, really feel it. As evidenced by the GFC, that all started in America. And so that, because America is such a big economy, the integration of pretty much every other economy in the world with America caused the GFC. And it's why that one change in America caused this big ripple effect. That being said, Australia actually did pretty well in the GFC. Again, the government spent a lot of money to protect ourselves, so it wasn't too bad, but Australia did feel the effects, and it was quite a big economic shock in Australia. So next, taking a bit of a look at GWP, so gross world product. So gross world product is the sum of total output of goods and services by all economies in the world over a period of time. So if you add up the GDP of all economies, you'll get your GWP, or your gross world product. So your GWP is calculated by the World Bank and measured in USD. So you'll see that most global indicators of economic activity or economic output are measured in USD, because your US dollar is typically considered the strongest dollar, because the American economy is typically considered the strongest economy in the world, or at least traditionally was considered the strongest economy. That's changing a bit, and we'll talk about that a bit later, but yeah, so anytime you see like big global statistics, unless said otherwise, assume they are in US dollars. So yeah, your gross world product is a good statistic to know and to be up to date, or as up to date as you can be on it. So it's a good indication of how the global economy is doing at any point in time. So for example, like if you compare the GWP of like, let's say mid 2020, when COVID was like running rampant, to like right now, you would see like such a big difference. And that is a really good indication of how shutdown periods, decreases in trade, things like that or increases in unemployment can cause a decrease in global economic activity, using your GWP as one indicator of global economic activity. So, for example, the 2019 estimate for GWPs, this is a pre-COVID statistic, was 143 trillion. So it's important to know that your GWP is calculated in terms of your purchasing power parity. So essentially the PPP essentially is accounting for the fact that changes in exchange rates and inflation rates between economies will change how much a good is worth, how much it sells for, how much it costs to produce it, things like that. So whenever you see something's calculated in terms of purchasing power parity, it essentially means that the World Bank is trying to account for differences between economies to get the most accurate reflection of economic activity in the world. So you can see between 2014 and 2017, your GDP growth, according to the IMF, had increased and was forecasted to decrease in 2019. Then if you can find the statistics for 2020, 2021, 2022, you will see generally a trend of decreasing GWP or GDP. So some more trends about GWP and the global economy. So your GWP in 2016 was over 50 times the GWP in 1960. With economic trends, and whenever you find them, I think it's important to try and explain why is that the case. So why is GWP 50 times what it was in 1960? So examples for that: increased economic integration, increased globalization, advances in technology, advances in transportation, allows things like greater imports and exports into an economy, which means more people can buy and sell, things like that. Growth in GWP has slowed since recovering from the GFC. So one reason for that being that government spent a lot of money in the GFC to boost the GWP. And sort of as that GWP was boosted, government slowly started taking money back, or not taking money back, but stopped investing so much money because the economy no longer needed such a boost. But without that increased investment, your GWP is still growing, but it's growing at a slower rate. So the GFC of 2008 to 2009 led to the first downturn in global output since 1946. I think this is pretty self-explanatory. Major financial crisis, a lot of people lost jobs. People don't have jobs, people don't have money. No money, no spending, essentially. And especially when people lose their money or lose their jobs, they're forced to rely on their savings. And so typically when individuals are forced to rely on their savings, they're less likely to make discretionary purchases. So essentially, they're less likely to make non-essential purchases because they are on a finite resource of money, because they don't have money coming in every week, month, year, whatever, from employment. And then the final trend, growth of the world economy slipped from 5.1% in 2010 to 2.9% in 2013. Again, similar to the recovery from the GFC, just less money being inputted into economies because economies were slowly, across the world, were slowly starting to gain their feet again. So in the recovery from the GFC, they were so slowly starting to become more independent, less reliant on government help as well. And also from that, increases in globalization also meant that a lot of companies had to spend a lot of money on increasing technology, increasing their transport. So they had less money to input into product, which can lead to decreased GWP and GDP. Okay, so some more trends. 2013, 2016, GWP growth remained below average. During the GFC, advanced economies contracted by an average of negative 2.7%, whilst China and India had slower but positive growth. So this is a really interesting statistic, especially if you are going to talk about the GFC, which I think the GFC is a pretty good example to talk about with a lot of your globalization stuff, GFC and COVID, because it really shows how dependent economies are on one another. So it's important to think about why might economies, so at the time China and India, so economies like that, why might they not have negative growth? Okay. One of the reasons for this being is that a lot of advanced economies didn't want to, invest, trade with, have relations with China and India, because at the time they weren't seen to be as strong of an economy as, say, the EU or the US. And because these economies were newer and still fairly emerging, they were less reliant on the rest of the world. So essentially, they weren't as reliant on the US. So when the US crashed, Yes, they still felt some effects, like economies are, you could say, are all integrated to some degree, but they weren't as strongly tied as, say, Australia would have been, because they were fairly newer economies. And so their positive growth lessened the fall in world GDP to only negative 0.5% in 2009. So some more recent trends, looking at the impact on the global economy, still thinking about GWP, is that COVID-19 has had a really big impact on the global economy. Like I said, super important or super good examples to talk about are the GFC and COVID. So projected global growth at June 2020 was 1.9% below the April 2020 World Economic Outlook. So this can just show like how economies during COVID, when they were essentially isolated from one another, there was a really sharp turn in economic growth across the world. And so the spread of COVID-19, in addition to the lockdowns worldwide, have slowed recovery to pre-pandemic economic growth levels. Although, like I said before, Australia is a bit of an exception to that. Relatively, we did pretty well. So that's a really, interesting point to include in your discussion of COVID is Australia's uniqueness to these general trends in recovery to pre-pandemic economic growth levels. And that's just a little link there if any of you guys are interested in looking a little bit more at that. So moving on to the global economy. So, we're still in the global economy, more like globalization, specific indicators of globalization. First one being increased trade in goods and services. So as a general trend across the past 50 years, there's been an increase in the trade of goods and services because of technology advancements in transport and communications. So because countries can communicate better with one another, it's easier for, say, somebody in America to order a product in Australia because of increased internet and telecommunication. There's an increase in plane services, plane efficiency, boat efficiency, train efficiency, things like that. And there's been a large increase in global trade in goods and services. And this is good because countries don't produce all goods and services that they need as efficiently as another country may produce them. So therefore, the countries that can't produce these goods as efficiently import these goods and services because economies don't produce all items that they need. They will only produce those that they have a comparative advantage in producing, which hopefully you guys are recognizing this as a little bit of a sideways way of talking about opportunity cost. But yeah, economies will produce the goods they have comparative advantage in producing because they are the goods that they can get the most money out of selling. And the more money they have, better of quality of life that they can have, and then therefore increased money they can still buy the goods and services that they don't have within their own economies. So a lot of governments have actually encouraged trade and trade liberalisation, including the removal of protection, in order to encourage economies to only produce what they are efficient as producing, which gives them a greater flow of money as well. So between 1990 and 2016, you can see a rapid increase in the trade of goods and services. So in 1990, 30% of global output happened as a result of trade in goods and services, increasing to 58% in 2016. So the annual growth in the value of trade is generally twice the level of world economic growth, which just gives you a bit of a picture about how important it is. As well as new technology in transport and communications have also reduced costs of trade. The more efficient transport and communications are, essentially the less they cost, which is why a lot of companies, as well as a lot of governments, invest a lot of money into transport and communications as well. So, looking, I guess, at this little table, we've got changes in composition of global trade. Okay, so how has the composition of trade changed? So essentially, how has it changed what goods and services are traded? So global trade is still dominated by manufactured goods, including cars and electronics, although it is declining. This is because not every economy can produce these efficiently because they are really expensive to initially set up production. So for example, Australia does not manufacture many manufactured goods. We used to do manufacture cars until the protection was removed on that industry because Australia just could not do it efficiently. So Because of this, that's led to a demand for energy sources, because the more you manufacture, the more energy you need. So things like oil and coal, which is really advantageous to Australia. And one of the big reasons why Australia did so well during COVID was because Australia has big amounts of those minerals. So the thing is, energy is something that people are going to need, COVID lockdown or not. People are always going to need energy, which is why Australia, just did so well during COVID, because people still needed our goods. And your big services, finance and communications are growing. In Australia as well, education is becoming a really, really big service that Australians export. And then changes in the direction of trade is the other big thing you want to think about when you're talking about trading goods and services in relation to topic 1. So your fastest growing economies, China, Indonesia, Vietnam, have had a rapid increase in trade. This is because as they're getting bigger, they can both produce more and also have more money to then demand more. So you can see an increase from 7% to 19% for those really fast-growing economies. That being said, high-income economies are responsible for the majority of international trade, things like the US and the EU. But that's a lesser percentage, from 82% in 1995 to 66.5% in 2015. So keeping on going on with the indicators of globalization, the next one we're going to look at is financial flows. So as a general definition of your financial flows are movement or the flow of money between countries in the short term. So it is the most globalized feature because money can move freely between nations. With the introduction of electronic banking, it is pretty much instantaneous to transfer money, let's say from Australia to Russia, for example. You can pretty much do that instantaneously, despite the thousands of kilometers that separate Australia and Russia. And this has been encouraged by the fact that countries have relaxed rules in regard to finance since financial deregulation of financial systems sometime in the 1970s or 1980s, depending on the country. So because of financial deregulation, it is so much easier for individuals to send their money here or there, for companies to trade or flow money between countries as well. The next big indicator of globalization is going to be our technology, which we've talked about a little bit. So technology has been the major driver of growth of global financial markets and has linked financial markets. So essentially, your financial flows have grown since the 1990s, although they fell during the GFC, but have since had a strong recovery because technology has allowed things like the Forex to exist. So the Forex is the foreign exchange markets where buyers and sellers exchange one currency for another. Technology has also allowed for individuals and companies to invest overseas. So it's easier for an individual in Australia to, say, buy stocks or shares in an American company because of technology connecting the two countries. So technology really is the big, facilitator of a lot of globalization. So the next thing I want to look at with you guys is globalization. Why do I keep saying globalization? Investment and transnational corporations. So there's two big types. So this is something that you guys are going to talk about so much in topic 2 when you look at the balance of payments. Unless you've already looked at the balance of payments, then you're going to know what I'm talking about. But your two big types of investment are foreign portfolio investments and foreign direct investments. So foreign portfolio investments are short-term speculative shifts of money as finance when you buy less than 10% of shares in a company. So this is essentially buying and selling of shares or securities in existing companies worth less than 10% of the entire company. So it's short term, it's when people buy some shares, they wait until they grow or sometimes until they fall and sell them off. So your short term speculative shifts. It happens a lot because people are like, let's say like a lot of people in COVID are like, need to buy like health supplies, so I'm going to invest in like a health company and, hoping that health company increases in price, which means they can sell off their shares for higher price, make profit. The second type of investment is foreign direct investment. So this is long-term financial flows of money to establish businesses and existing companies or to buy a substantial proportion of shares in an existing company in order to play a management role in the business. So your foreign direct investment is when somebody buys 10% or more of a company, or they establish a completely new company. And the thing that differentiates your foreign direct investments from your foreign portfolio investments is that FDIs, so your foreign direct investments, are when investors want to play a role in management of the business or the company. And in order to do that, they need to buy 10% or more of a particular company. So some trends in investment in the transnational corporations. So your foreign direct investment flows fell a lot during the global recession due to ongoing policy uncertainty, geopolitical risks. People didn't know what was going to happen during the GFC, so they didn't want to spend a lot of money essentially buying a company out, buying at least 10% of a company. And they didn't want to play a management role when there was such uncertainty and risk going on in the economy. So the OECD expected FDI to fall by around 40% in 2020. And FDI inflows traditionally favoured developed economies, America, Japan, the EU, things like that. The reason for that being is there was more certainty investing in developed economies. There was less turmoil, there was typically less political risk, and typically you could just predict what was going to happen to shares in a developed economy, which is why those inflows typically trend towards those economies. On the other hand, developing economies such as China, India, Brazil, and Mexico have seen an increase in FDI flows as they become, bigger players in the economy and grow in size. So currently, FDI inflows to these countries have received more than 50% of total inflows. So they do have a really, really big share in recent years. And developing and transnational economies significantly increasing share of FDIs as well. So now looking at technology, transport and communications. Again, we've sort of talked about this, and I think with technology, transport, communication, it's quite self-explanatory. I think the big thing here is just to talk about some of these statistics. But essentially, developments in freight technology, such as containerization, has led to greater trading goods. Essentially just means that more goods can be transported at once. It's easier to transport goods, more efficient to transport goods. Say with things like technology, internet users have increased 12% to 33% from 2000 to 2010. So you can see there's a lot more people on the internet. Technology is becoming a lot more advanced, and a lot more people across the world is getting connected. And important communications technology links businesses and individuals in the global economy, which means that there is a decrease in costs because it's so much easier and quicker to talk to somebody say in America from Australia. And like we talked about, technology facilitates the movement of money as well. Another thing to talk about in regards to globalization is the division of labour and migration. So because it's easier to transport not just goods, but to transport yourself from, say, Australia to London, that used to be like a months long trip. Now you can get on a plane and it'll take you probably about a day to get from here to London. So this has led to an increase in the number of people moving away from their country of birth to foreign locations. So there's a current estimate that 3% of people work outside their country of birth. So labour is the least globalised feature because while it is easier to get from one place to another, in order to work in another country, there are a lot of national barriers, immigration, legislation, language differences as well. And if you just want a bit of a, finite, definite definition of migration, migration is the movement of people between countries on a permanent, long-term basis, usually for 12 months or longer. So the reasons for migration is that countries can utilise labour skills at a lower cost. They can locate industries offshore to emerging and developing countries for job displacement in advanced economies. So essentially what this means is that big transnational companies will recognise, okay, it's cheaper to produce this particular thing in this country. So what they'll do is they'll offshore it and they will produce all of that particular thing in one economy. And they'll use people from that country to produce it. And essentially what that means is that jobs in advanced economies become displaced because they are no longer the cheapest place to produce something. A good example of this is Apple. If you Google like Apple production process, you'll see that a lot of the specific things that go into Apple phones are produced all across the world, wherever they're cheapest, and then they just get put together in California as well. And so then going across from that, we've got the International Division of Labour, which is essentially how tasks in the production process are allocated to different people across the world. So highly skilled individuals are attracted to rich economies such as the USA, which has resulted in brain drain from Australia. So essentially what brain drain is when people study in Australia because for whatever reason, maybe that's you were born here, you study here. If you're from overseas, maybe it's cheaper to study here than your home country. For whatever reason, people study in Australia, but then as soon as they've got their degrees, they'll go off to richer economies, such as the USA, where their particular skills are going to be rewarded with higher wages in another country. A big example of this is people who study things like medicine. They'll study it in one economy, which is where they, for whatever reason, that's where they got in. It's cheapest there. They had family there or whatever. And then they will take their medicine degree and they will practice overseas somewhere because it pays better. And that's a really good example if you want to look it up about like the medicine brain drain. Not just Australia, it happens all across the world, particularly in a lot of developing economies as well. But that's just one example of something you can talk about with the International Division of Labour and a potential disadvantage of globalisation as well. Okay, so that wraps up our power run through globalisation.